Well, good morning, Wealth Press viewers, subscribers, traders, and investors. It's time for another weekly Monday morning roundtable, and I'm joined today by Roger Scott, Jeff Gastine, and Jeff Santanieri. Gentlemen, welcome.
Hey.
Thank you for having us, James.
Hi, James. Hey, guys.
Hey. So we start the week with a uptrend in the markets, and wow, another vaccine company has announced 90% efficacy. I'm just waiting for the CEO to announce he's going to sell 60 or 70% of the company. And but it looks like we're heading into a situation where, you know, that the crisis is over. And I know that, Roger, you're going to tell me that it's too soon to think that, but that's the sentiment being demonstrated in the market. So I'm going to start with you, Roger, and ask you, what is the correct sort of perspective to have going into the market this week?
I wouldn't be too fast to jump on board just yet. I think the markets are actually at a crossroad right now. I think the market right now is seeing a tale of two cities, so to speak. On one hand, you have the increase of infections growing at a huge rate. And we also know that even if the vaccine comes out, which it's not coming out till December something, a couple of weeks from now or a month from now, that most people are not going to get it this flu season, which means there's going to be another quarter of economic damage. So the question really is, how fast can the vaccine become practically effective versus how much faster and how much more damage the COVID will do before it becomes effective? And I think that's what the market is trying to figure out right now. And I think that's where the market's at right now. So I think we have to be very, very careful because we're starting to see similarities to what we saw last March and last February. We're starting to see that. New York schools are closing down. My wife was just telling me last night that in California, schools are closed. We're starting to see a little bit of these spikes. Again, it's a little quicker this year because obviously, you know, we don't have to wait till February to get there. But we're starting to see alarming numbers. So it's kind of like to give you a good analogy, it's kind of like there's a fire burning. There's a house that's on fire. And it's a little fire. It's not a big fire. And the question is the water going to get fast enough to be able to put it out before the fire burns? That's sort of where we're at right now. You know, we kind of don't know if we're. It's a very interesting position right now. If we had this exact same conversation a month earlier, then I would say, you know what? I think the water is going to get to the house and it's not going to burn it down 100%. But right now, with the numbers just skyrocketing, and I'll tell you another thing on a personal level. Last season, when this whole thing was happening, I didn't know anybody who was getting sick. I now know a lot of people who are getting it. So I'm seeing this thing really penetrating. It's not just some hypothetical Washington spook. This thing is really impacting people I know, a lot of people that I know. I just came home because somebody that works for me, relative, may have it, and I had to do a broadcast from the house versus the office because they may be sick and they're going to get tested right now. This was not the scenario in February. So my point is, it's I think we're in an influx right now. Now, when you combine that scenario with the holiday week, which is a fragmented week, and when you combine it with a boatload of news that's coming out this Wednesday, it's very, very hard for me to get an accurate read on this market. Sorry I took so long with my explanation, but I really wanted to explain how I feel about the whole thing.
Sure. Well, that's interesting. I mean, it's interesting because in Canada, we're having record outbreaks as well. And in fact, Toronto just today is going into a full lockdown, which Toronto's being Canada's largest city is remarkable. But so Jeff Z, how about you? Are you seeing anybody getting infected, and what's the effect on your position vis-a-vis the markets?
Yeah, I know people Roger's spot on. I didn't know anyone for like the first 3 months of this thing that got it. And, I'm not a hoaxer. I didn't think it's not real. Of course, I think it's real. But now it's like really impacting people in my community here in Miami, people in my kids' schools. My wife's a teacher in a school and other teachers have it. And it's very real. The hospitals aren't collapsing, thank God. So that's like the big thing, right? And the treatments are much better now. Um, but let's talk about the markets. People are in risk on mode. There isn't really much of a connection between what's happening in Main Street USA and what's happening in the stock market right now. And there kind of hasn't been for a long time. And we are playing with funny money. Interest rates keep going, like the 30-year. I was just looking at the 30-year mortgage and it keeps making new lows. And in the past, when we've been in that situation in like the mid 2000s, early 2015, we keep seeing like, a trend to zero here in the US on 30-year fixed. And there's like a window where you're like, I got to lock this in or it's going to disappear and it's not worth it for me to refinance. And you don't have that feeling at all right now. You feel like interest rates are going to be pressured to stay low. You feel like the Fed's going to keep pumping. The one thing I would say is that what I'm nervous about, and I don't hear anyone talking about this, is the gridlock between Washington, between Congress and the White House, the Biden White House that's coming, is being sold as like this wonderful thing. But it's really not that great if you are depending on fiscal stimulus to happen in a big way. And there are huge pockets of the economy that are going to need a lot of fiscal stimulus. There's a huge population of people that are like waiting in lines just to get their Thanksgiving dinner. This is a tragedy like we haven't seen before economically in this country. And I think there's just a huge disconnect between people, frankly, like us, that are less impacted economically, and the people that are really impacted economically, which are in the millions and millions, who are going to need some sort of concerto coming out of the government, which I don't think is going to be there.
Interesting. Jeff Yasteen, are you aligned with these viewpoints or do you have a different take?
Well, just talking about the market for this week, I think it's just going to rise. I mean, like Jeff was saying, it's risk on, and it's seasonally, a bullish period of the year. Going back to what we were talking about for the vaccines, my view of it is that, presuming that we start seeing these vaccines distributed to people, in the middle of December, as the headlines were saying anyway, every month that goes by is another, X millions of Americans for whom they're not going to be worried about COVID as much. As far as how that relates to the market and the way things are positioned right now, the thing that has me worried is, even though, again, we're either going to have a melt up or we're going to have some sort of reversal soon, meaning like in December, perhaps. And the reason why I say that is because as these vaccines get distributed, the stay-at-home trade, so much of Wall Street is heavily invested in stay-at-home stocks, and the biggest tech stocks are generally also stay-at-home stocks. And you can imagine the degree of capacity that's been built up or anticipated to build up on all that. And now, as we move beyond that and can envision a post-COVID economy, I can see where some smart traders on Wall Street may decide to start wrong-footing everybody and start selling out of these positions simply because everybody is loaded up into them. And I noted the other day, Bank of America, their monthly fund managers, mutual fund managers survey. After months of them, basically either being on the fence or bearish or just in cash and just not sure, going into the election, there was election uncertainty was the big thing. Now they're finally getting bullish, super bullish. And that would have me worried, not for this week, but I can see where if the Russell 2000, which has been the strongest of the major indexes, kind of stays at these levels, broke out the new all-time highs last week. But if the other major indexes don't follow suit, then that may be setting in a pattern for the good part of 2021, where essentially the big institutions are selling out of these very large and market cap tech stocks, and positioning elsewhere. And that's just going to drag the rest of the stock down. I'm not talking about a crash. I just mean in terms of some sort of slow motion correction. Could it be a bear market? Maybe, but part of me says there's just no way I can see that happening. But because I think that, there's also part of me that says, well, expect the unexpected, and that would certainly be it.
Sure. The end of the year is typically replete with large capital pools in the form of hedge funds and investment funds and ETFs who rebalance their portfolios. There's depending on what kind of year it was, a degree of tax loss selling, but generally we see a flight of liquidity from the market towards the end of the year, and then it returns in January. And is that pattern, that historical pattern, is that something that we need to worry about this year as much as years past? Is it the same old as far as that's concerned? Roger, what do you think?
Well, I'm glad you brought that up. Typically, what you're talking about, that whole December rally that sometimes happens, sometimes not. Most people don't realize, but the biggest cause for that, or the biggest trigger for that, is retail sales. Strong retail sales from the holiday shopping, and before that, and that's what typically triggers those rallies that tend to stand in and shape the first quarter of the following year. So you're absolutely right in terms of it happening. And the biggest cause of it is retail. So the question is, are we going to see that this year? And I don't know. I don't know right now. It's very, very hard for me to gauge that. If the economy was getting some love from the Fed and central banks in terms of aid, then I would say maybe 75% yes. But right now it's hard to say, and I'll tell you why. September retail sales were extremely positive. The October retail sales were not bad. They were pretty good, but there was a lot of red flags, okay? And if you were to talk to a lot of analysts, they would tell you a lot of that had to do with the fact that Americans just don't have money right now. Unemployment levels are still at 750,000. So if we remain in the position we're in right now, it is doubtful that we're going to have that strong retail sales data. And if that does, and also COVID, again, as I mentioned when we first started this broadcast. So in my opinion, based on what I'm seeing right now, and this is not just based on my theory, this is based on the numbers that we're seeing from the retail sales data. I'm not as hopeful that we're going to get there as I was a month ago. With that said, things can still change. We could still there's still some time between now and the end of the year. We've seen a lot of surprises this year, and we may get it, but every day that goes by that we don't get aid from the Fed is one less day that we're going to see that happen. So that's my thought on that.
And Jeff, Jeff Z, what do you see happening towards the end of this year, going into the first bit of 2021?
So I'm inclined to think, I agree with both of you in a way. It's a very difficult year, though, because it's unprecedented. It's uncharted waters. But typically, when you have a big up year in the markets, there's a huge panic to get that risk on from portfolio managers to be in the big high-flying winners. They just can't show that they didn't own these stocks. So in a perverse sort of way, if they can say that they were at the party for 10 minutes, then they were at the party, So they do press these things into New Year, into year end. Thanksgiving week is typically a pretty bullish week on really low volume, but not always. And there's a lot of dislocations. I did a little research that showed that the best sector, as Roger was saying, is typically retail, outperforming almost 2-1 the rest of the S&P 500 in the week before Thanksgiving's Black Friday and the week after. So over a 10-day rolling stock trading period, it's over 10 years worth of data, the last 10 years, it's doubled the performance of the S&P retail. This year is a little bit strange because retail has been on absolute fire since the first Pfizer announcement came back. So I'd be a little suspect on retail leading us, because I think if my guts are right, my gut instinct is there's going to be some misses from some retailers on Black Friday. There's going to be some soft numbers from certain people. different places are going to be different. Like, video game sector is on fire. People stay home a lot. People want to play video games. Video games, big seller around Black Friday. My kid wants a PS5. These bad boys cost $500 if you could find them in the store. If you got to buy them on the black market, like they're trying to force me to, they're like $1,000, $1,500. And I'm like, dude, just take a deep breath. I'm a trader. I don't pay extortion prices. I wait. I fade extortion. So I'm trying to teach that to a 10-year-old. Isn't so simple, but I'm just showing you some of the dislocations that are happening nowadays in the economy in real life. It's a tale of two cities. Apparently, a lot of people have $1,500 to drop on a video game system. I don't know.
Wow.
It's incredible.
Yes. No kidding. And Jeff Yasteen, what's your take on all that?
I'm like Jeff Z and Roger. I'm giving you my best guess. I mean, I guess that's what investing, speculating is all about anyways, is, odds and probabilities. But my best guess is that a lot of the seasonal end of year trends that we typically have seen that you were describing in the question, I think have already been played out. And my sense of it is that, unless we see some sort of reversal, like I said that earlier, that is a long shot. And I really can't believe that it's going to happen. But unless that happens, I think, we're going to see the retailers move higher. I was watching like Tanger Factory Outlets, Real Estate Investment Trust, even Simon Property Group, even with the COVID raging and everything, that stock is up today. And I think it's like a 3 or 4 month high on that one. So to me, that should bode well for this. And again, unless there's a big reversal for the market, I think we're just going to see this melt up, and that's going to carry all your retail stocks and everything higher.
Sure. So given that, I mean, from where I sit, it's interesting because, Canada is just not the size of the market of the U.S. So our retail is basically characterized by what happens in the U.S. But in the U.S. this year, the retail has these twin headwinds of increasing pandemic, more restrictions on physical shopping, resulting though in a greater amount of shopping online. They've got the tailwinds of the vaccines creating a sense of hope for the future, and the sense that the pandemic, if not over, is certainly got a light at the end of the tunnel. And then we've got the annual sort of bull run that occurs around Thanksgiving and Christmas shopping. So with that whole pattern and nest of indicators being disrupted, then are you guys saying that retail is the place to stay away from for now, to let us see how this season plays out? Or should we be putting some capital at risk to get in front of our convictions for bearish or bullish? And again, Roger, I'm going to start with you.
I think the answer to that is very, very simple. I think we could what we could do is we could ensure ourselves by going with the retail stocks that have adapted well to online. Those have been staying up, and those have been leading the relative strength for several months now. For example, Gap, L Brands, Coach. Coach went from being one of the worst relative strength stocks to being one of the best relative strength stocks in the last few months. And then you have Target and Walmart, who have already told us last quarter that they have done an amazing job of converting their brick and mortar clients to buying things online. So I wouldn't go experimenting. I would go for sure things. Like, for example, 2 quarters ago, about a month and a half ago, I told you that Crocs, those shoes, were the hottest selling. Lululemon and Crocs were the hottest retailers. So if I was a betting guy, I could still go on retail and find stocks that will more than likely either outperform the S&P 500 or be fairly resilient in light of the potential sell-off, because they've been doing so well and they have adapted to a new environment. So there's a sort of a way to have your cake and eat it too, if you know which stocks to look at. And I just named 4 or 5 stocks that I believe will do well, regardless if the entire consumer discretionary environment And I think it's more than retail. I think it's the consumer discretionary environment, which the retail is obviously part of. But that's what we're really talking about. So I think there's still ways to ensure profits, but you got to be extra selective. In other words, it's not going to be like it was 7-8 years ago, where 90% of retail stocks goes up. It may be, but even if that doesn't happen, you could still find some amazing bets and stocks that have converted well from the retail sector to the consumer discretionary sector and have embraced e-commerce over the past several quarters.
Okay, Jeff Z, are you planning any particular strategy towards retail?
So I just exited on Friday a bullish XRT retail position, and it could go more, but I think the move is sufficient. I mean, Gap's tripled in the last 4 months. Some of these stocks they've shot the moon. Those companies will continue to do well because they have a good digital game. And again, are you a trader or are you an investor? From an investment standpoint, the guys that know how to navigate the new reality, because there is a new reality, they're going to continue to outperform. If you're a trader and I see those kind of moves, I get a little bit nervous. I think that the risk to the downside remains on the sector as a whole, but my central thesis isn't based on the retailers. I think we could be in a situation where you see retailers get whacked and the stock still go and the broader market going higher because it's back to tech leading. And that's my actual case, because I do think the NASDAQ is going to close the year the strongest index in the world. It's been the strongest index in the world for the last 10 years. It's been the strongest index in the world this year. And I think people are going to still panic into those names in the long run and the short run. That's my bet.
Interesting. Jeff Yasteen, do you have a game plan as it pertains to the retail sector?
For the retail sector, I would focus on the ones that are still the most beaten up and are moving higher. And again, if they're moving higher in the environment, like Roger was saying, where you got this, these COVID headlines, and it all seems very scary, and they're moving up despite that, I take that as a good sign. And there are still a lot of stocks, like there's one I was recommending a while back earlier in the year, Vera Bradley. I mean, they had to close a bunch of stores. They went through restructuring the last couple of years, and the stock is moving higher. It's doing well, and I would expect that they'll continue to do well through year end. So, to me, for retail, I would look at value plays, and if you wanted to go for like momentum, Five Below, which is a really great retail format aimed at like college kids and teenagers and younger kids. It's basically a dollar store, but everything's like $5 and $10. That's a good one to look at. It's at new all-time highs. So really that's more of a momentum thing. But again, if you think that the market's going to continue melting up higher, that would be another place to play things. As for an overall strategy, I'll stick with what's worked since the middle part of the summer, which is, what I've been saying here all along, which is banks and energy are great places to look, as well as transportation. And I think those three are going to do very, very well, simply because much of the recovery is not priced into those yet. As where I would disagree respectfully with Jeff Z on that. I feel like for tech, not to say it can't knee-jerk higher because of the portfolio dynamics of fund managers, buying what looks good going into year end, simply because that's what they need to show their clients and their investment committees. But as far as where you can find real performance, I would stick with those: energy, banks.
Okay. Let's talk a bit for a moment about the vaccine stocks, because I've got a whole bunch of subscribers who are following them, and the sense is growing among them of that they've missed the boat. I mean, Pfizer's come out with its vaccine, Moderna's come out with its vaccine. Today, AstraZeneca announced its vaccine. We're now coming out at a rate of about a vaccine per week with 90%-ish efficacy. And that sort of gives one the sense that, if any vaccine contender is wallowing around in a phase 1, phase 2 trial, it's too late. The game is over. The problem has been solved. And And now it's just a case of, well, which are going to be the have versus the have-not stocks and the vaccine producers that actually get a vaccine to market in this first blush that is clearly going to have the advantage of first mover. And so, Roger, my question for you in this very long-winded and convoluted fashion is, are there any vaccine stocks or opportunities in vaccines or the biotechs more broadly that you think bear some attention from investors?
Not right now, James. I believe, and this is if you recall, going back several weeks, I was comparing this to the internet sector in the 90s. How, when anything relating to the internet, if you bought a .com domain name in 1996, all of a sudden you were looked at as a big, as a big deal. And that's kind of what happened with the biotechs and the vaccine stocks in late February, March, and April of this year. But I think now the market has become so efficient in terms of understanding where we're at in the game compared to where we were several months ago. I think there's a big premium on the stocks that are in phase 3. And I think they're priced in. Most of the value is priced in. And I think a lot of the other stocks that are either disappointing researchers or not involved in the vaccine have been kind of thrown out. And you got to be really careful with biotech. You've got to be really careful. And I'm just not seeing any value or anything positive. I would almost rather at this point focus on biotech companies that are not involved in COVID, because those stocks could be possibly a little bit undervalued. But in terms of the COVID stocks, I'm seeing internet in the mid 90s and I'm seeing a big red flag, and I'm seeing a lot more disappointment than anything else. I think we're at the point where the market capitalization is going to go into the big companies, and it's not going to have as big of an impact. For example, Johnson & Johnson. I mean, this COVID thing is going to be huge for them, but it's not going to reinvent the company. So I think that in terms of what we already know is priced in, especially with the big names, and what we don't know or what we may not know has been undervalued. So I think there's a big divide now in biotech, almost kind of like what we're seeing in commercial real estate versus residential real estate. It's like two different worlds. So I would be very, very cautious. And if I would go with biotech, I would focus on something that's completely that's rising, that has nothing to do with COVID. As a matter of fact, I would stay away from COVID right now.
Sure. And Jeff Z, I know you make the point consistently that you're not so much a biotech investor, and there's great peril to investors who would be tourists in the biotech sector. So in that context, is there any interest for you in biotech at this point, or is it just kind of like, the COVID thing was interesting, but considering most of these big companies that are turning out viruses are multi-SKU companies where one thing's not going to make them, is not going to impact the balance sheet that greatly on a quarter by quarter basis. Is there any interest in biotech for you at this point?
As a general rule, I'm going to build on what Roger said and say it kind of in a different way. If there's a lot of hype, I sell hype. The same way I buy panic, I sell hype. And if something is purely hype and there's going to be a difficult time monetizing it consistently forever, I'm a seller of that in general. Can you get hurt selling that in the short term? Yeah, you can get your face ripped off. Would I be buying hype like that for the long term? Hell no. That's the worst time. That's like doing the extortion trade and buying a $1,500 PlayStation 5, right, in my opinion. When I say you buy tech stocks that fund manage, back to a point that I was making, that fund managers are buying, that's different. Those are companies that are shaping the reality of the future across everything. And the only way that the game stops them is by government intervention, because they're winning so strongly. They're destroying other, competition within subsectors, within industries. And the only thing that can stop them is antitrust and things like that, because their natural predatorial instincts are to dominate markets that they enter. Like Amazon, for instance, when they announced they're doing an online pharmacy. Are you going to bet against them having the best online pharmacy in the world? Probably not. So my point is that when you have hype situations, it's different than paying a lot of premium for people that are pretty much guaranteed to win. There's a difference because you can be expensive and worth it, but you could be expensive and hype, and you can be cheap and still be too expensive. And that's a hard thing for value people to get, which is why they always get their value traps happening, is because something is cheap doesn't mean that it's not expensive. Like, why do you think Exxon is trading with a 9% yield right now? 9% yield for Exxon, because there's huge risk to what people think they're going to be able to pay in terms of revenue looking forward 5 years out from now.
Wow.
It is what it is.
Yeah. Interesting.
And if you start yielding 8%, 9%, you're junk. You're junk bonds. For people out there that don't know, that's when you become a junk bond, is at those levels. And you learn from watching bonds. You learn from watching corporate bonds, reading yields. That's how like real institutional people grade risk. So there's a lot to learn from that too.
Yeah. I could,
just to add,
sorry to go off on a rant, but it is.
No, that's good.
Just to add,
Roger?
Just to add to what Jeff, that was, you did that very well. You put that together very, very well. I commend you on that, especially the part about value in the end. And interestingly enough, several months ago, I was talking about a stock called Moody's. And I was saying how important the stock is, because what Moody's does is they grade bonds, stock bonds. So I was saying how now more than ever, the integrity and the value of this company is very important. I don't even know how they're doing right now. They were doing pretty well about 5-6 months ago, but I think the symbol is MDO. But my point is that this company is very relevant because there's not a lot of companies that do that. And if a company grades bonds, upgrades or downgrades a bond, that could be very significant for a company, which is kind of what Jeff was just talking about. Well, so listen, I thought it was just very interesting in light of the discussion we were having about Moody's bonds.
I'm speaking from firsthand experience with the financials in 08. You had Lehman Brothers go out and Bank of America was trading at $25, and then it went to $12, and people were like, damn, it's so cheap. And they were yielding on their preferred shares 9% on their preferred shares. People were like, what? These guys were, they issued these preferred stock at 3.5% coupon. Now they're yielding 9%. And it's like, woo, guess what? It went to $3. It went from $12 to $3. So I'm speaking from firsthand experience, guys. This isn't like, I'm not making this up. Like, I've been through those wars. Like, listen to people that have been in those
wars. Is there
wars.
A trade here where you buy the stock yielding 9 and go short the stock while reaping the yield as long as it's intact?
Well, that's interesting. There can be ways to do that. But typically what happens because of the capital, well, that's a capital structure arbitrage, and that's a different question.
Right.
I could spend 2 hours on that, but we don't got that.
Yeah, exactly. Okay, and Jeff Yasteen, let's finish with you. Did you have any sort of sentiment towards biotech and the possibility of making money in the hype of the COVID-19 environment, or is it a stay away stock for you as well?
I thought I had missed Moderna too, to go back to your original question. I thought I'd missed the move because I wasn't in these vaccine stocks earlier in the year. So I only bought Moderna for myself like 2 months ago, and I'm up like 40% or so. And if you look at the valuations for like a Moderna, this is a company that's going to earn a little over $3 a share next year. So if you want to apply, even a 40 or 50 multiple to a stock like that, now you're talking a stock that's still going to continue to move higher. Is it going to be a momentum play, and be captured by the whims of momentum, risk on, risk off, and all that? Yes. And so, it's not like put it all on red or put it all on black kind of stock. But I would say no, people have not missed it. And frankly, what I've been doing now lately is going back and looking at a lot of the stocks. I think you were even talking about them, Jim, before I joined Wealth Press, Vaxart and Dynavax and Inovio and some of those. Those all were run up back in May and June, and then were sold way down. And like Vaxart's up, I don't know, it's practically doubled in the past 2 weeks. So I would start looking at circling back to some of those. And last thing I want to do is just to take the other side of the idea of, there are value traps, and we have to make sure we avoid those or get out of them early. There are also growth traps. And when we talk about things like Exxon, which I don't own, but for a company like Exxon, the reason why it's yielding 8% is because everybody and their brother, has been pumping oil and fracking shale oil over the last, 10 years, because there's been this huge mania, and it's been supported by, cheap financing and all the rest, and add in OPEC, and that's where your oversupply comes from. Now, post
There's no
COVID,
demand. There's no demand.
Post-COVID, though, as we will see demand picking up. And the supply end is where people need to focus on, because right now there's a record low number of rigs out there in operation, and you can't just turn these rigs on and off. So that's where the supply and demand component comes in. And that's where I would say, if you're looking for stocks that you can buy based on valuation level and good risk reward, that's why I still say energy, yes, fossil fuel energy, as well as the new energy plays from the Biden administration.
Sure. Okay. So there's a great way to wrap this up for the week. Is if we're looking at energy and particularly oil stocks, and we are seeing the vaccines that are giving us a strong sense that maybe not in 2021 everybody will get a flu shot, but definitely in 2022, then doesn't that imply future demand for oil is going to pick up with the increase in travel? And so now is actually perhaps a good time to get involved, or is now too soon and constitutes a value trap until we see more of those moves happen to solidify demand around oil? And Jeff Z, I'm going to start with you on that.
Short oil, man. It's in a secular decline. People we've shifted the way we live life, whether we like it or not, whether there's a vaccine or not. People don't drive the same way they used to. People don't fly on planes the same way they used to. People don't do anything in terms of activity.
Sorry to interrupt, but one thing I'll say here is just that look at car sales in a place like India, where there's 1.3 billion people. Even through the pandemic,
but we're not talking about
they're having record car sales.
Talking about how far they drive. Let me finish my point. Sorry. And they can shut rigs on and off. They do. So OPEC, who controls the supply of oil from the nations that are part of OPEC, have been trying to strangle the market to bring it into equilibrium, and they still can't. So if we go back to 2019, which I highly doubt we ever will, you could still say a max value at oil before COVID even started was around $55 a barrel. So if we're trading in the low 40s, what's your upside? Another 15 to 20% from here, but your downside, in my opinion, is you're back into teens. So if you think of risk reward the way I do, I'm not going to risk $3 to make $1. I like to do that invertedly. Okay. And so you have the reason EV is flying the way it's flying is because it's also creating a much more efficient environment for energy. So you have so many things working against the price of oil going forward that it makes me almost blind. The only thing going in oil's favor in terms of pricing is the collapse of fiat currency.
Wow. What a segue that is. Collapse of fiat currency. Holy smokes. I don't even know where to go with that.
We're seeing it already. What do you think Bitcoin's doing what it's doing and all,
you're preaching to the converted here.
Yeah. You're seeing it you're seeing in risk on assets.
I laugh.
That's the only thing keeping oil from a full collapse that I think is invariably going to happen.
And obviously I would completely disagree with that, but that's what the markets are all about. If we see that oil moves back into the mid 30s, low 30s, obviously I'm wrong. And if it moves higher, whether it's because of currency collapse and that sort of thing, which I think is a possibility, or for more fundamental reasons, we can sort of cherry pick why that's happening. But the main thing is to be in stuff where you see the risk reward. And obviously we kind of look at things differently. But the main thing is assessing risk and reward. And that's something most investors, especially when you're new, do not do.
Right. Well, we're running over time here, but Roger, I feel like I don't want to leave you without weighing on that entire oil industry versus the collapse of fiat currency that is underway as we speak, giving us some perspective on that.
Well, I was looking at electric powered vehicles the other day, and I'm looking at companies like Workhorse, and they're in bid right now with the Postal Service to make 180,000 electric powered cars. That's the first time in history something like that's ever happened. I believe that I believe that there's a big fundamental shift in oil. I believe it's happening right now, and I don't want to get into the big debate but I would wait to see what would happen. If I was a betting man, the risk to reward right now is to further short traditional energy. If I'm wrong, and there's a chance I'm wrong, I mean, that's fine too. I would want to wait and see for some validation of what Jeff Yasteen is saying, because you were talking about India and all that. A lot of those third world countries are now planning on aggressively shifting into non-renewable energy, which is why stock like Albemarle, which makes 21% of the world lithium, is at all-time highs. Now, it may be too early. We may be too early and yeah, it's true. There may be a resurgence of gas and energy, but quite honestly, I think we are right there at a fundamental global shift. And I may be wrong. And if I am, I'd want to see traditional energy really take off, really, really take off. But I will say this to everyone here. My mother-in-law, who just retired about 6 months ago, she worked for ExxonMobil, and so did her husband. They were career engineers. They moved here from from Houston. And before she retired, she was just telling us that the changes that they're seeing right now are fundamentally the worst they have seen in decades, and that usually they'll get bids and they'll get contract from overseas drillers and frackers years in advance, and they're not seeing any of that right now. So from what I'm seeing and from what I'm seeing in the market, what I'm hearing from fundamentals and people in the business, I tend to agree more with Jeff Zananeri. But, we've had these arguments before many years ago, and traditional oil has a way of bouncing back, so to speak. So from a risk to reward ratio, I'm agreeing with Jeff Zananeri. But if it does happen again, don't think I'm not gonna take advantage of it. But I think we would have to see a major shift in economy for Jeff Yasteen's argument to come to fruition, to take place. We may see it, but we're not there right now.
Thank you very much for your time today. And we'll be back next week with another roundtable. Thank you all for watching.